Good morning. I'm hoping everyone can hear me and see my screen. Typically, I would have my camera on, but GoToMeeting seems to be experiencing a bit of a problem. So I've put my eyebrows on for very little reason, but it's okay. Thank you so much for joining us today. We've got quite a big group, which will be good. Um, I've got an example client that I'm going to run through. If I just click through to the agenda, we've got a couple of features that have gone live recently. And in order for me to showcase those, I've had to create quite a complicated CashCalc client just to be able to include all of the features there. So these are some of the new ones that we've gone live with. I think there's one more at the bottom. So we are going to take a look at the savings and dividends. We'll cover off income tax. We've got pension salary sacrifice, capital gains on a GIA. We've also got chargeable gains on bonds as well. So we're gonna cover that. A little bit of housekeeping. I think everybody would automatically be put on mute already, but there is also a chat box. So if you do get any questions during the session, please feel free to pop them in there. I'll stop at certain points just to check and answer any. And if we don't manage to get through all of your questions, somebody will reach out after the session to make sure that they get answered. So I'm going to hop into the CashCalc system now. Excellent. So the example client that we've got today, her name is Mary. She is 50 years old. She's hoping to retire at age 60, but for the first forecast, we're going to assume she's retiring when the state pension kicks in. She's a recently worked on client, so I can just click into her name here. And I'm picking this demo up assuming that I've either brought information in from IO or I have onboarded the client already via CashCalc, so they've completed a fact find. And if I hop over to the info tab, you can see along these different sub tabs here, we already have news of an ISA, a pension, her lovely property, some income here, which is her salary, as well as her ongoing expenditure. So we've already got that in the system, and there is therefore no need for us to rekey any of those information pieces. So all I need to do is click Update a Calculator, and we are of course choosing the gross modeler so that we can see all of the tax that is captured within there. We need to give the forecast a name. In this case, I've just gone with current situation, and you can see below all of the different inputs I just mentioned that are going to pull into the calculator. Once I've exported that, you can then see these different numbers along the relevant tabs. Those are those bits of information that have pulled through. So if you are using the onboarding functionality or you have an integration with a back office setup, then less rekeying and more time with clients, which is pretty much, I think, what every advisor wants. So my advice to everybody using CashCalc, really, whether you've used it for 5 minutes or 5 years, is to work your way down each of these tabs on the left-hand side. So we'll start with assumptions. At the moment, these features are relevant to inflation, the different types of inflation rates, and how long that forecast is going to run until. I've chosen to just run it until age 100. And beneath this, we have some assumptions on what we would want to do with any surplus income. So this is relevant for if we ever have a forecast where the client is earning more than they're spending. The system by default will typically save that surplus income. So you might see a current account that is accruing over the years a client is working. Now, if the client is not doing that and there is no surplus income, we can of course just put that to 0%. Or if they're actually putting their surplus income in another one of their savings pots, an ISA, a pension, you can click to do that. A few notes on the detail and the tax of that. If we are putting surplus income into an ISA and it is above the ISA contribution threshold, you will sort of get an insight to tell you to address that. There's too much going in that ISA in that year. And if we are making contributions to a pension, the system will assume that those are personal contributions and gross up for tax relief. In this case, the client is not saving any of her surplus income. There isn't, each month she is contributing to her ISA and pension, etc., but there isn't a large amount of money accruing in the current account every year. So I'm going to pop that to 0%. The next tab down, we have people and timeline, particularly important if you are in Scotland, want to tax it correctly. In this case, we'll stick to England. And beneath that, we have our events timeline. This is particularly useful for this client. She's not yet retired, and there is some flexibility as to when that retirement is going to start. So what we'll do when we come to her income, her work-related expenses, her pension contributions, we're going to link all of those things to start or end where this retirement event is. So if we want to see the effects of retiring 5, 2, 3 years earlier, all we'd need to do is just drag the event down and the pension contributions and salary will stop in time, for example. So I'm happy with retirement there. You can also drop any other events on the timeline as well. If you just put other down, it'll ask you to rename it. So if you've got a client that has a very specific financial goal about paying for a child's wedding or helping them with their house deposit, you can put their real-time goals in the timeline. Savings and investments, I've got a few bits to add in this section, so if I go quiet, it's just because I'm concentrating and adding them in. To start off, we've got a current account. This is a mandatory pot within the cash flow. So occasionally I have advisors tell me, oh, I don't need a current account for this forecast, I'm just looking at the pension. So CashCalc absolutely needs the current account to run its calculations. Any income, be that a salary, the state pension, any expenses, any withdrawals that are coming out of an ISA, for example, they are all using the current account. So our incomes are going to come into the current account and our expenses come out of it. So the current account will always be there when you log in and you create a forecast. My ISA here, or Mary's ISA, should I say, I'm just going to make some changes to the growth assumptions. We do have two options here. We can either put an input, i.e. 4.26%, or we can choose a template, which would be a variable growth template. A bit of additional information that I'm not going into too much depth on today. We have recently gone live with an integration between CashCalc and FE Analytics. If you have portfolios in Analytics, you are now able to use that data. It will take the underlying asset allocation of that portfolio, and you can use that to generate a linear return using the last 5 years historic performance as an average. Or you can generate a variable return, again, looking at the asset allocation of the template of the portfolio itself. That would then sit under templates, under portfolios, and you can see here I've got a few that have been brought through by either myself or my colleagues. For this particular example, this ISA specifically, we are receiving a 4.26%. It is a sort of a fixed cash ISA, so we'll just stick that to a linear return there. Add that in. The client also has an additional savings pot that is just cash, and this is her emergency fund. So I'm going to add that in, emergency fund, which is cash, but you can see the different wrapper types we have here under categories. Pop that in, and this is 15,000. And I'm just going to leave that at 2%. And below here, we have the inputs for any interest that might be payable. So this is going to, our client in this case is a higher rate taxpayer, so this is going to adjust the personal savings allowance up to 500, down to 500, sorry. So in terms of a percentage on the interest, let's pop that in at, let's put that in at 3%, and I'm actually going to increase this to 4%. We choose to either reinvest the income or not, and what that'll do is it'll decide as to where that interest is going. Is that going into the client's current account for spending, or is it going back into this cash emergency fund? In this case, it is going back into the cash emergency fund, so I'm just going to click yes on the reinvest button. One of our newest features to go live is chargeable gains. So I'm going to add some details of bonds that the client has here. So we'll just call that bonds, and they are onshore bonds. The original investment was £5,000, and that was split across 10 policies. The initial commencement date was 10 years ago, so let's put 2015. And the starting pot value is what the pot is worth today. So we'll put that in at 8,500. We can then input some details as to the previous withdrawals or previous top-ups. I am going to do that. So in 2020 to 21, the client took out £1,000. And that was a regular withdrawal, but you can see here we've got options for full encashment of individual or partial across all policies. We'll take that as a regular. And under previous top-ups, in 2017, 2018, the client put an extra £2,000 in there. We can add that in. Again, I'm going to put an input rather than use a template on this. I'm assuming the client is a balanced investor, so let's put 4% in there. It's an estimate. Put that in, and I'm going to save that. So we'll come back to what that looks like when we get to our outputs later on, so you can see how those pots have actually been affected by tax. But I am just going to continue working down each of the tabs on the left hand side. So we'll move on now to our pensions tab. So the pension that the client that we've already brought through, the client's input it via a fact find. It has pulled into the system already. So I am going to make some slight tweaks to this. So we've got a pension with Aviva, £300,000, and beneath that you'll see a button for inherited pensions. So this is relevant if the pot is tax-free. So if we've got a pension that's tax-free, we can select that it is an inherited pension and therefore tax-free, or you can say it is actually still taxed as income. In this case, it's not an inherited pension, it is Mary's pension. The pot is fully uncrystallised. She's 50 years old. If it wasn't fully uncrystallised, we would need the uncrystallised pot value, and that's just so we tax it correctly later on. But in this case, I'm ticking that button. To show you the difference here, I will choose a template. As I mentioned, we can bring them through from FE Analytics and actually map our cash flows to your CRP, CIP. But in this case, I'm going to use an example benchmark that we have within the system. So this is using UT and OIC data. So if you were, or if the client was a cautious investor between the years of 1990 and 2024, so quite a long period there, 34 years, we would experience, or we would assume, this sort of level of growth. So we're just capturing that volatility over that period of time. So I think this drop here would have been around 2008. So yeah, we can add all of that detail in there. I am just going to pause a second just to check if there's been any questions come in. Okay, so if so I'll pause here and we'll come back. The state pension is a good place to pick up on. I'll answer some of the questions just because it saves us going back and forth. So if you can't see the option of allocating surplus income for different pots, what I would say is that there's a few things that might be going on there. It is a relatively new feature. So if your forecast was created before that feature went live, you won't be able to see it. If you clone that forecast, it should then pop out. Alternatively, if you don't have any other pots in the cash flow, it's not gonna, you wouldn't have the option to choose different pots. So I would just check those things. If it's still a problem, we'll reach out to you following this session just to troubleshoot it. But I think you should be okay. As I say, if the buttons entirely don't exist, you don't have this here at all, clone your forecast and see if it pops out then. It might be the forecast was created before the feature went live. Guidance on how to potentially model fees for long-term care. Yes, anything sort of in the future, if we were doing a long-term care case, what I would recommend is to add in potentially a life event for potential long-term care to kick in here and link in the expenses for that. The system will try to cover any unexpected expenses using the capital that the client has. So if there is a shortfall in the case of long-term care needed to be paid for, it will become very, very obvious. I would start at that point. That's how I would do it. But again, we can pick up again after this session to go in a bit more depth. Yeah, if you set the excess income to 0% to save, it won't matter if the income exceeds expenses. It just won't accrue. It would assume that any surplus income is not saved. And importing your bespoke portfolios from analytics, what I'll do, I'll crack on with the session and cover all of these features. And at the end of that, providing we have time, I will show the import feature from FE Analytics to get your portfolios into CashCalc. Okay, so we'll crack back on now into the state pension. For anybody that has been using the net modeler historically, you may have realised that the state pension in the gross is no longer hidden behind a quick add button. It is just front and centre. The system will know the client's age and therefore when the state pension is going to kick in, and it will assume that we are getting the full amount. If that is not the case, you can edit that and put in an adjusted figure. In this case, the client is getting the full amount, and I want that to adjust between now and the start of it in 17 years' time for inflation. So I've got that box ticked. The client's income, i.e. her salary, has pulled through, so I am going to make some slight tweaks to this. The inputs for salary is a bit more detailed on the gross cash flow compared to the net modeler. We do need to know how we should be taxing this, i.e. company director, should this be a dividend? In this case, it's employment, it's taxed as employment, assuming PAYE, and there are no bonuses to add in this case. I do want to link the end age here to the life event for retirement. and that will enable me to move retirement up and down the timeline, and it'll adjust when the salary ends. And we also recently went live with a feature that will quickly capture salary sacrifice and other pension contributions. So if I click to include pension contributions from salary, I do want to contribute this to the pension. It is salary sacrifice, and in this case, the client's very good. She's putting 10% per annum into the pension from her salary. If they were receiving a bonus, you can also choose to include that as part of the pension contributions too. You can also capture if an employer is allocating NI savings. In this case, they're not. And under employer contributions, the employer is also great. They match up to 10%, so we'll pop 10% in there for that element. So in updating the income there, we've just created a couple of extra contributions, and we'll see those when we get down to it. Our expenditure, that's pulled through from the back office or the fact finding process. And the next feature we have, again, very new, we've got the ability to transfer. So essentially we can pick which pot we are transferring from and which pot we are transferring to. And so let's say from the ISA we're topping up the emergency fund, or let's do it the other way around actually. From the emergency fund we're going to pop that in the ISA, and let's just do ISA top up, and let's say we are going to put £5,000 at the point of retirement, one off at the point of retirement. There are some options in the advanced drop down here that are quite relevant, I think. The tax exempt one, I think, is going to be most relevant if you are trying to model a pension consolidation. So if you've got a client with multiple pensions and we want to consolidate those into one pot, we can transfer all of those pots into the one pension, tax exempt. And the prioritising transfers before planned withdrawals, let's say, for instance, we've got a client that is typically taking 4% a year from their GIA, and they are selling their house and the proceeds for that are going in on that year. If you want the transfer to happen before the 4% withdrawal is taken, you can specify that that transfer is the first thing to happen before any other withdrawals. So this feature, massive time saver. Prior to this going live, we used to, essentially the system would move money out of the pot you were transferring from, put it into the client's current account, and then you'd have to manually create a second contribution to move that money into the pot it was being transferred to. So it was a bit of a workaround, but we don't need to do that anymore. Another good thing about it is you can also clone your transfers. So in instances where you're doing bed and pension, bed and ISA, or if you've got spousal transfers and you're working a cash flow on behalf of a joint client, you can clone that and just make the top ups, change it that we're also putting money into the pension, for example, and it saves you having to sort of all of that. So again, very nice new feature that we've added in. And contributions, I haven't actually created any of these. These have all auto-populated based on previous things that have been added. So we've got our emergency fund savings, the interest being reinvested into the emergency fund. We then have the two pension contributions, both auto-generated from those salary sacrifice assumptions. And we've split out the employer and employee contributions there. In addition to this, the client is actually contributing every month into her ISA. So we'll add the legal and general ISA contributions. This is a personal contribution, i.e. it is coming from the client's current account, not from outside of the client. and this is an amount of £500 per month, and realistically it's going to finish when the client retires. You'll also notice on most of these inputs, all of these inputs, there are escalation rate assumptions to be set. So the system will default to assume you want things in line with inflation, CPI, and therefore at the end the results that you're going to get will be in real terms, assuming that money is maintaining today's buying power throughout the entirety of the forecast. So we're going to hop into the withdrawals tab now. I'm only going to add one withdrawal in this case. It's going to be a future withdrawal from the bonds, just so I can show the full feature. The other withdrawals, I'm not actually going to take any. I'm not going to take any manual withdrawals. CashCalc will take money out of the savings pots to meet shortfall if there is shortfall. So I'll show you that before we add any more. But bonds, let's say bonds for income, let's say in a couple of years' time she's planning a nice big holiday. This will be a partial encashment taken across all policies, and it will be for the amount of £5,000. And let's say this is happening next year. She's going on a really nice cruise, and this is where the money's coming from. So we'll add that withdrawal. I'm also going to go back to my expenses now, just to highlight when a withdrawal is taken, it is very similar to a withdrawal from an ATM machine. So if you took money from the hole in the wall, £200, it's no longer in your bank, but you still have £200 until you go off and spend it. And the same is true in CashCalc. If you take £5,000 from a bond, you still have £5,000, it's just not in the bond anymore. So what I'm going to do is go to my expenses and spend that money. Again, this would be a good opportunity to utilise that events timeline, add in the event for the big holiday next year. But in this case, I'm just going to pop it to 51. Now, the last inputs that we need to address are charges and fees. You can separate these out. You can have different charges on different pots, and you can separate your fund, platform, advisor, ongoing advice. You can separate them all. I am just going to group them all together and add them to the pension. So let's just do charges, and as a percentage, this is 1.3% per annum, and we would assume this will run indefinitely. We'll add that charge. Okay, so a lot of inputs there. As I say, in order for me to go through each of our new features, I've had to make it quite a busy case, but we'll hop over and have a look at some of the outputs now. So if we go to our cash flow forecast, we've got 3 graphs to look at. Our first graph is the savings over time, and this one shows the client's the different pots the client has and the value of those pots in any one given year. We can also hide all of these pots. So for anybody that is going through a cash flow forecast with the clients in the room, or you've gone out with an iPad and you're showing them, you can hide everything. And I think this is really just for theatrical value, but you can really sort of highlight certain pots. So if we just want to look at the pension, for example, we can see that this is going to sort of run out around age 90. And we can build up the rest of the pots and add them in there. But in this case, we've got pension, which we can see that variable growth. If I hide that pension, you can see everything with a linear return is looking a bit more linear. And the pension here, we have the volatility. So we have that graph, sorry. Our second graph is the money in versus money out. So what we have here is the actual cash flow in and out of the client's current account. So I've got the black line representing the expenditure, which is spiking next year as a result of the extra expense for our holiday. And then all of the different coloured bars are the different sources of income that are meeting the expenditure. You'll also see a second line down the bottom here. This is the essential expenditure, which we split out. Again, at the bottom here, you can highlight or hide certain bits. So if you just want to have the total, you can have that there. But I think it's quite nice to see for clients to see their essential expenditure, how close they are to meeting that with their guaranteed incomes. The different coloured bars are then the different sources of money that meet the expenditure, as I say. So during the client's working life, we've got this nice big salary. And then in red above that, we've got the interest from our emergency fund. We've got the bond income, which is happening next year for that holiday. And then later on, we'll be getting the state pension. And this is that ISA top-up. So where we have a pastel colour, this is deficit met by savings. So this is where the system is taking money out of a savings pot to meet shortfall. And if we hover over here, we've got our deficit met by the pension, and it will default to UFPLS in the first instance. And once UFPLS has all been, once we can't do that anymore, it would move on. We've then got, sorry, that sentence made no sense. If you've got a client that's actually taking PCLS and they're utilising tax-free cash earlier on in the forecast, the system will default to UFPLS until tax-free cash is gone, and then it'll flick over to Flexi Access. Now that is just the default. If that's not what you want the system to do, and you want to specify that a client is not just going to live off their pension for 20 years and then move on to their ISA, they're likely to take a portion from both simultaneously, that is where you would come over to these withdrawals, and you would add in a withdrawal to say, let's say spending ISA and 5,000 every year from the point of retirement indefinitely. And if we hop back over to that graph now, we'll see an extra bar running along the cash flow. So this green one has just popped in. So we've got spending ISA, and that has then reduced the shortfall, and we're taking UFPLS until we jump back to the ISA to cover the last bit of shortfall. Now again, the reason why we're choosing the pension first is because of a pot liquidation order that has been set. You can change this. So I'll hop back to our inputs, and I can either go to the savings and investments tab or the pensions tab. The same button appears in both. We can set pot liquidation order. You can use the arrows, but I prefer a drag and drop. So I am going to swap those out and keep, let's put the bond higher than the emergency fund, and then update the pot liquidation order. If I go back to cash flow, we're now taking the ISA before we go near the pension. And then in the very last years, deficit met by bond and the emergency fund is kicking in. So a bit more on there, the backstory about this client. So she's fairly confident that with her current level of spending, if she retires when the state pension kicks in, everything will be okay. But realistically, with 17 years left of working, she's wondering if there's anything she can do to retire at age 60 instead. She does have a very nice property. So what we're going to do is clone this forecast and see the effects of downsizing and using the proceeds of that in a GIA. So I can then show you the CGT on a GIA feature. So over on the last graph, we've got our taxes currently paid. So we can see income tax, national insurance, and later on when the pension's used, we are also getting some income tax creep back in. We would also capture capital gains here, but in this case we don't have any of that going on. Now, where this particular calculator really sort of comes into itself is when you get into the yearly breakdown. This is where you will see all of the detail on the tax stuff that we've just input. So whilst the client is working, we can see her salary. It has been adjusted to accommodate the the salary sacrifice contributions. So we have an adjusted taxable earning. We can then see exactly how much of the income is landing in which tax bracket. So we can see personal allowance, basic and higher rate. And if we were getting more than the personal allowance if we were receiving more interest on that emergency fund and crossing over the £500 band, we would be capturing the tax here too. We've got an insight for next year. This is going to be relating to the chargeable event. So we withdrew £5,000 at age 51 because the withdrawal did exceed the 5% allowance. We've exceeded, a 2,000 chargeable event was created, and after applying top slicing relief, some of that fell into the higher rate tax band. Hence, we are now paying some tax, and the tax treated as paid is the reduced final bill, accommodating top slice. And yeah, but we've got all that detail in here as well for you. If we jump forward a few years, we can then, I'm just to show you where we have multiple incomes. We've got the state pension, we've got personal allowance. And we can see here some of the personal allowance crossing over into the ad hoc withdrawal from the pension, and then the remainder being captured by basic rate. Money out is our expenditure. And another good bit of information that you can find in here is anything that you've added in as a percentage, i.e. a charge or a withdrawal, you'll be able to see the nominal value in here. But this liquid assets tab will show you how a pot has performed in that year, factoring in things like how much was contributed, how much was withdrawn, what growth and inflation was doing, and any charges and such. So it just kind of zones in on the pot value of that year and what's contributed to the change. So the client was eager to see what would happen if she retired at age 60. So because I've linked everything to that retirement event, all I need to do is clone my forecast. And let's say retire at 60. We are cloning our existing current situation. If I hop back into the inputs and timeline, all I need to do is move retirement to age 60. And if I hop over to the incomes, you can now see salary is finishing at 60. If I go over to the contributions, that's also changed to 60, as well as the ISA one that I added in as well. So if we hop over to our cash flow forecast and look at our money in, money out, it is this white period at the end here. This is where we've run out of deficit. So we've run out of capital to cover the shortfall. And as a result of that, the client is running out of money, sort of mid-80s. I'm going to make one more clone, and we're going to call this downsizing. And although I am choosing downsizing as the story to show this feature, it really is applicable to any instance where you have a client that is receiving a large lump of capital in the future. So it could be that they're selling a business and the proceeds from that sale. It could be a large lump of inheritance that we're expecting. But if I go to the downsizing feature, the downsizing forecast, sorry. First thing I'm going to do is drop an event on the timeline. We're likely to be looking at downsizing in the next year or two. I don't know if anybody saw the figures, but the property that she currently has is worth circa 1.2 mil, and she's thinking that she could probably downsize, get some net proceeds of around 300k, and use that as the ticket to retiring earlier. Got downsizing, we'll add that in. This is going to come into a GIA. So I'm going to call this GIA proceeds from downsizing. Now, the original investment as well as the starting pot value are going to remain at £0, and this is because the money hasn't come in yet. So if we've got a future lump of capital coming in, pop an empty pot in, and then we're going to contribute that figure in at the future date. When that money does land in this GIA, it is going to be invested, and again, I'm going to keep it to cautious in line with her investment strategy. We'll add that in. And under contributions, we now need to actually put that money in that pot when the downsizing event happens. So let's put net proceeds from downsizing. This is not a personal contribution. It is not coming from her current account. It is external, and we're thinking it'll be around £300,000 as a one-off happening at the point of the downsizing event. I am going to adjust that for inflation between now and next year. The other thing I'm going to do is shift the GIA up the liquidation order. So I'm going to say that once that money comes in, that'll be the first thing she uses to cover any shortfall at a later date. Add that in. And we could again go in and manually add in a withdrawal, but if I hop back to my yearly breakdown now and I click into, let's say, this year, apologies, not this year, I'm looking at the wrong year. We hop into when that shortfall first starts. We've got money in, ad hoc withdrawals from the GIA, proceeds from downsizing, and we are therefore now capturing the capital gains tax payable. You can specify, as I say, the same applies to the previous forecast. If a client is not likely to just spend from one pot until it's fully depleted, you can absolutely go into your withdrawals and specify, well, they're going to take a bit from here and a bit from there. This is what the system would do if it's not given that information. So if we go back now to our cash flow model, the GIA pot is sort of popping up out of nowhere. It doesn't exist in the first 3 years, and then we have this extra pot for the GIA. If I just hide everything else so you can see it more clearly. There we go, GIA later on, and that is the first pot used to cover any shortfall. Once you have done all of this and you've got all of the features sorted, all of the inputs sorted, and you've created your different what if scenarios, it is just a case of clicking create report. In this case, I am going to include just the downsizing and the current situation forecast. And once that's ready, you can click that into a PDF. You do also have the option to choose a Word report. And the PDF is going to run in a very similar order to the tabs on the left-hand side that we just worked our way down. It will give you all of your inputs, and then you'll get your 3 graphs and the yearly breakdown, non-expanded version. And then we get our graphs. and that non-expanded yearly breakdown. This is quite a large report in this particular instance, just namely because the amount of inputs I've included, and it is also 2 forecasts. For a 1 forecast report, you're probably looking at around 13 pages, 12 to 13 pages. And yeah, that kind of concludes the session. I am going to I appreciate the session is supposed to finish at 10:45, so for anybody that can't go any longer, thank you so much for coming along. I am going to hang around. I'll try and answer some of the questions, and I will also hopefully be able to show some of the integration between CashCalc and analytics. Yeah, thank you so much for coming. I'm just going to have a sip of water and then I'll come to the questions. Okay, DMB, that is in relation to, if we hover over here, DMB GIA, deficit met by. Deficit met by. We do love an acronym in financial services, don't we? So let me have a look at some of the other questions we've got in here. Is there any workaround to change the investment return on the same pension or savings pot at a point in the future, i.e. at retirement a client is likely to take less risk and therefore growth assumptions would be lower? So at the moment, the way that you would need to do that is actually very similar to what I've just shown in this downsizing exercise. If you create a second pension with a £0 starting value and you have the lower growth rates on that, you can use our new transfer feature at the point of retirement to transfer 100% of the higher risk pension into the lower risk pension pot. Make sure to click that it would be a tax-free transfer, and it will essentially look something like this. So let's just do it, shall we? So we've got a high risk client while she's working. And that is a starting pot value of 0. We've got the input, so let's just put template. That will then become cautious, fully uncrystallized, add that in. And then if I go to transfers, add a transfer, this would be from the pension to the lower risk pension. Oh, let's put 100% as a one-off at the point of retirement, tax-free, and we would prioritise that transfer before anything else. Add that in. £100, not quite what I was after. 100%. Let's try that again. Okay, so if we come here, what we have now, the pension's changing colour, it's moving to a different pot, it's got lower risk, but that would be the method for changing risk profiles at the moment. Okay. Yeah, so if you're doing a bed and ISA or bed and pension and you don't want to have to do it every year, um, the transfers, you can just select that it's an ongoing. No, that's wrong. I'm in expenses, bear with me. Edit. I have chosen a one-off in this case, but if you're doing it every year, you can choose every year and have that ongoing. And then if you're doing, two transfers or transfers to multiple different pots, you can clone it to save having to sort of rebuild every single one. Yeah, so there's another question now for under the GIA input. What does the sorry, I'll put my teeth back in. Under the savings and investments and the GIA feature at the bottom here, we've got interest and dividends. So these are the fields that essentially tell the system whether or not we should be looking at the personal savings allowance, and if for higher rate taxpayers it should be adjusted down to £500. If you click that there is interest to be paid here, then it'll ask for a bit more information, and is that being reinvested? But essentially, let's say we did have interest of, let's say, 3%, and it is being reinvested. If I go back now to yearly breakdown and the GIA here, we've got the proceeds from downsizing, the interest, we've got the interest being reinvested. I maybe need to increase that to make it a bit more, but yeah, it's in relation to the personal savings allowance. Excellent. So bear with me. I'm just going to stop sharing my screen for a minute while I just get my analytics uploaded and logged in. And then once I've done that, I'll start sharing my screen again. And I'll show you how to do that feature. I'm hoping now you can not see my screen. Is that correct? Yeah, perfect. Okay, bear with me. I'll just quickly jump into analytics. I do seem to be having some problems getting into analytics. Okay, I am not going to be able to do that. But what I can do, I've got a guide that I've created, so I can send the guide out, and I'm going to try and put together a short video. But for some reason, I'm getting an error message, so I'm not able to get into the system. I'll share my screen again and find my. Here we go. There we go. So once again, thank you so much for coming along this morning. Appreciate we did run over a little bit. If I have missed any of the questions, I've tried my best to go through them, but I'll have another look through after the session's finished. And if I've missed any, I'll reach out, or someone will reach out. Thank you so much for sticking with me, and I hope everybody has a lovely rest of your day and rest of your week. Take care.